Well, good evening, everyone, and welcome to our webinar this evening. Tonight's webinar, Maximizing Your Real Estate Tax Benefits, Part 2. If you were here joining us 2 weeks ago, welcome back. This is your first time joining us. Welcome. Thrilled to have you. And do not worry if you did miss Part 1. My colleague Joe Feng is going to do a quick review of it, but also a reminder to all of our webinars can be found on YouTube. We post them all after our they're all posted on YouTube after the run. And if you ever need to find one too, feel free to reach out to us so we can send you the direct link. So like previous webinars, tonight's webinar, we're going to be taking questions at the very end of it. But at any point you have a question, please go ahead and put it into the Q&A box at the bottom of your screen. And also, tonight's topic, maximize your tax benefits. At the conclusion tonight, too, we're actually going to give you a couple examples of ways to, in fact, do that with our current offerings. So we just have to flash these on the screen, the confidentiality and disclaimer. Don't worry, I'm not going to read it. So we have to show that screen. And same with this one, the financial disclaimer. But again, do not worry. Not going to read it verbatim, just have to show it to you. So Break of Day Capital overview. I know most of you are familiar with us, but those of you who are not, what do? We acquire underperforming multifamily properties in high growth markets in the Southwest. Once we acquire them, we implement repositioning strategies and best-in-class asset management to maximize the values for our shareholders. We were recognized by the 140,000 member AOA, the American Apartment Owners Association, as the best syndicate company of 2022 and 2023. Inc. Magazine has recognized us as a growing real estate company. We have done over 280 million in real estate transactions. And of the deals we've done, 4 have gone full cycle. And when we exited them, the returns far exceeded our projections. Now, asset management expertise, one thing I found in multifamily is a lot of people are really focused on the capital raise or focus on the acquisitions, but they don't spend as much time as they should talking about the asset management. They kind of view it as maintenance, when something that a good operator can use to really differentiate themselves from the pack. And based just on the asset management component of multifamily syndication, we've been able to boost the NOI 40% within the first year of operation for 9 consecutive deals. Now, Gary Lipsky, you can see on the right side of the screen, he's written a best-selling book called Best in Class about asset management. If you are interested in reading it, you can go to our webpage, breakofdaycapital.com, and order it. Just have to pay for shipping. And for those of you who love podcasts, the Real Estate Investor Podcast is Gary Lipsky's podcast. Highly recommend subscribe to it. If you have an iPhone, just under podcast, type in his name, it'll show up. Now, our mission statement, a lot of people often glance over these when they're reading, looking at investment options. And I highly recommend you do read. I think this is one of the keys to choosing somebody. What are they looking to do for you, and what's their goal? And our mission is to provide passive income, passive investors with superior risk-adjusted returns with the highest level of transparency and fiduciary responsibility while improving the quality of life and community for our residents. Our core values are diligence, integrity, transparency, communication, and Kaizen. Kaizen is a Japanese business term where one looks to continuously and constantly look to improve themselves. Now, here's the Break of Day Capital's team. Not going to go into everybody's bio. If you want to learn more about us, you can go to our webpage, again, breakofdaycapital.com. But for those of you who do not know, may know I have spoken to some of you in the past. My name is Adam Drescher. I'm the Investor Relations Manager. Just quick background about myself. Before I joined Break of Day Capital, I spent 20 years on Wall Street, mostly doing sales and sales trading. Then about 8 years ago, moved to Arizona, started a small business, got into real estate. I was a multifamily realtor for several years, where I first met Gary, and joined the team last October. My colleague Joe Fang, he too has a real estate, Wall Street background. He worked for a hedge fund in New York for many years, and then an asset manager in Los Angeles. He has invested in 6 Break of Day Capital syndications, and he's invested in 60, that's correct, 60 commercial real estate syndications among several different asset classes. Sean Conchilera is our Director of Operations. He is going to be our moderator and host this evening. He is a tech executive. That's where his background is. He was in the tech sector for numerous years, and he has been invested in real estate for over 2 decades. With that, I'm going to turn over to my colleague Joe, who's just going to go over, just do a quick recap of the last webinar we did.
Thank you, Adam. All right, guys. Before we get into the part 2 of our webinar this evening, just a quick recap of what we spoke about 2 weeks ago. I'm not going to get too deep into this. If you missed the first one, there's a recording of it. Ask us for it, and we'll get it to you. But basically, we talked about 3 big things 2 weeks ago. We wanted to define what depreciation is, and it's basically one of the best benefits that you can get from real estate investing that is not available for most investments. And what it is the IRS actually allows you to take an expense for the wear and tear of your investment property without actually money out of your pocket, right? So instead of paying for something and expensing it, and which you can offset against the income, you can take this depreciation without ever spending a penny into the property, okay? So this is a very powerful way to offset your taxable gains. Then we also mentioned something called cost segregation. So the IRS allows you to do deduction, or sorry, the depreciation of the property over a period of time. For residential, it's 27.5 years. So using a standard deduction method, you can write off approximately 3.6% per year. There's a way to accelerate that depreciation where you can front load more of the depreciation expense up front using something called a cost segregation, where you're hiring a cost seg engineer to basically reclassify all the different components of the property, and such that you can depreciate the different components with a shorter schedule. And so instead of 27.5 years, you can break components down into 5-year bucket, 10-year bucket, 15-year bucket, 20-year bucket. And the net result of being able to do that is, rather than taking sort of that standard 3 to 4% deduction per year, you could potentially write off up to 35%. That's a 10x increase of the depreciable amount in year 1. And finally, we concluded the first webinar by also mentioning bonus depreciation, which is a tax bill that Congress passed in 2017, where it states that for all the depreciable items that are less than 15 years, you can take all of that. You can write off that entire amount in year 1. And so when it was introduced in 2017, you could potentially write off up to 100% of your investment dollars. And then over time, it went down. So in 2023, it went down to 80%. This year is at 60%. And so this is really a way of really supercharging an accelerated depreciation schedule using the cost segregation method. And so the take-home message from part 1 webinar is that it's not what you make, it's what you get to keep in your pocket at the end of the at the end of the day that matters. And one of the best ways to do that is to use depreciation. All right, with that, let me turn over the rest of the presentation to Sean, who will be leading the discussion tonight.
Thank you, Joe. I appreciate it. It's really good to be here with you, everyone. So again, welcome to part 2 of our 2-part series. Today's discussion will solely be focused on tax benefits for real estate professionals, also known as reps. This is one of my favorite topics because anyone who meets these conditions that the IRS has set will be able to take advantage of some pretty powerful tax benefits that a non-rep, would just basically not be eligible for. So in a nutshell, as you start to listen to the team talk about, the criteria and the requirements and how to track this stuff, these tax benefits basically will provide you with the ability to offset, as Joe mentioned, both well, he didn't mention it, but we're going to get into it. The key takeaway will be for you to think about being able to offset both your passive and active income gains. And that's a really big deal. And this means offsetting W-2, 1099, along with passive income. So with that, let's go ahead and dive into what it means to be a rep. Before we do that, we want to see if we can get this to work this time. We're going to do a quick poll and just see if the audience has a basic understanding of what this means. Doesn't matter if you do or don't, just trying to get you guys a little engaged and have some fun. So I'll go ahead and launch this poll and we'll give you guys 20 seconds and we'll go ahead and see what you guys think. All right, a few more seconds. Okay. All right, so the correct answer is, a person who meets criteria according to the IRS. So we'll go ahead and get into that. So let's see here. So Adam, can you go ahead and let's give the audience a little bit of a deep dive into what it means to be a real estate professional?
For sure. So, being a real estate professional, you're extremely lucky. It's the only profession that can actually use depreciation benefits to offset, your W-2 and 1099 income. Nobody else can do this other than real estate professionals. So as you can imagine, the IRS is going to have very strict guidelines of what one must do to be qualified as a real estate professional. So these are the 3 big tests. Now, the first one is probably in my opinion, is the one that really, knocks a lot of people out of that category. Is more than half of your professional service has to be performed in real estate. So that's the first one. And so that makes it very tough for somebody who has a full-time job outside of real estate to achieve that. Because if you think about it, I know people qualify as 40 hours is sort of the standard work week, but we all know most of us work well beyond that. Now, 168-hour work week, you take out sleep, about a third of that, you're stuck with roughly 100+ hours. So it's very challenging if you're an engineer working 60 hours a week. If you're a doctor with a practice who again works 50, 60 hours a week, it's very tough for that to have more than half your professional services be in real estate. So that's the first big test to be qualify as a rep. Now, test 2 is the number of hours. The number of hours is 750, which is turns out to be about 14, 15 hours a week. But the third one too is material participation must be demonstrated. And so only certain things that one does in real estate checks this box. And we're going to get into that momentarily.
Got it. So it looks like, Adam, basically what we're saying is, both test 1 and 2, they talk about this thing called real property trades and businesses. And it looks like we need to dive into that one a little bit more. So let's go ahead and do a quick pop quiz on what this is and see if the audience has a general understanding of this concept. We'll go ahead and give you guys about 20 to 30 seconds and then get into it. Oh, I see the audience is split on 2 of these answers. Very interesting. All right, a few more seconds and then we'll get started. See what the results are. Okay, so the correct answer is actually construction and reconstruction. So we really want the audience to understand, why that's the answer, along with all of the other criteria that go with, what is really real property, trade or business. So let's just go ahead, we'll close out this, and let's get started on the next one. So Joe, this one's for you.
Sure.
Give the audience a little bit more of a, just a really clear understanding of what real property trades or businesses means in the context of making the 2 tests.
Yeah, this is a topic that I've discussed with so many investors. Everybody has a definition of what they think qualifies, the activities that are necessary to be considered a real estate professional. But I'm actually going to read that first thing verbatim here because it's really that important. It's pretty definitive, what counts as acceptable work. Okay, so generally speaking, it's work that you perform on the properties that you own. Okay, and so here it is. Real property trades or businesses include the development, construction, acquisition, conversion, rental, operations or management or brokerage of real property. And in fact, Sean actually helped me learn this the other day, is that, if you ask any real estate CPA, they will tell you that most likely realtors actually qualify because they're in the trade. But there's actually additional nuance that, and maybe Sean will get into that after this. But you can potentially count the hours that you work as a realtor towards the 3 different tests that Adam mentioned earlier. But there is a distinction. It's not just, you have to be a broker, right? So it's, Sean, I guess you can take, I'll have you explain that after this. But that's basically what you need to know, is that there are specific tasks that are allowed for you to qualify as a rep.
Yeah, awesome. Thanks, Joe. So I think that definition is pretty clear. There are a lot of people even in the field who kind of try to figure out, whether this brokerage applies to them or not. And from what I've heard, several CPAs who've actually filed for reps, especially when it comes to realtors, is of course brokers who are full-time and who are a broker of a brokerage firm, of a real estate company. They clearly, they'll have no issues. Even if you're an affiliate broker or an associate broker, you might not be the designated broker, but you might still have gotten your broker's license and you're fully active, and you can very easily prove that you're fully active. You very easily should be able to meet, the requirements. The tricky part here is real estate agents who are not fully active, they're not full-time, and they're really part-time agents. They're not really spending the 50% of their time doing what meets the requirements, you know, for a rep. They're not doing the 750 hours. They can't log the hours, and we'll get into that with Joe and Adam in a little bit. But if you are an active realtor or an agent, and you're meeting the requirements, you should be fine. And I know several agents who are actually doing that. I've been kind of just checking and just trying to, talk to, their CPAs and just really get a good understanding of this. Because it is nuanced, and you talk to 5 different CPAs. Some of them will all give you different answers. So, this is something that you just really need to speak to somebody who knows what they're talking about. And you'll be in good hands if you find a CPA who's done this before. They're pretty confident. They know how to file for you. Joe, did you want to add anything else in this slide, or should we move on?
Let's move on.
Okay. Let's go ahead to the next slide.
So this is probably one of my favorite slides tonight. This is a great cheat sheet. So when maybe this is take a screenshot or print this out, but this clearly tells you what is acceptable activity and what is not acceptable activity. Like a lot of the stuff that you see on the right there, this is probably one of my pet peeves. Like, when you buy and read real estate books, if you attend conferences, you go to networking events, you attend tonight's webinar, I'm sorry to tell you, but none of those activities qualify you as a rep. You actually have to do something to the properties that you own. Whether it's, as I mentioned earlier, whether it's, repairs, renovations, dealing with the tenants, signing leases, making Home Depot runs, even if you have a property manager, dealing with the property manager, asset management, you actually have to do all those things that directly relate and benefit the properties that you own. In addition to a realtor being a broker and doing the activities that qualify.
Super. So just a few key takeaways. In addition to what Joe just spoke about here, again, I just actually saw a few more people join late, so I think this is super important. So I'm just going to make this point again. So just because you're a realtor does not mean you immediately meet the conditions of rep status. One really needs to be an active full-time agent or realtor who is handling third-party transactions, buying and selling, and being able to show all the hours that are involved in doing that, which should be pretty easy if you're an active agent. Selling and buying your own properties don't count. And I've actually seen that specifically kind of pointed out with one of the CPA firms, and they've done their work, so I trust them. And then, of course, being able to log those hours, and we're going to talk more about that. And then things like researching, real estate, learning about real estate, all the things that Joe mentioned, everything on the right-hand side does not count towards being a rep, and does not qualify. So just keep that in mind. All right, so let's go ahead and talk about what does material participation mean? And that's an important topic. So Adam, can you help our audience understand, the practical application of the term, and really what this terminology can often be somewhat confusing to people. So just kind of get into the nuts and bolts of this one.
Yeah, for sure. And I echo what Joe said about the last slide. That's my favorite slide tonight, to show people, what's material, what's not, especially because, there's some surprises there. I think people would think of like reviewing financial statements and researching would be considered it when it's not. But going back to when we talked about the tests, the 3 big tests, 1 and 2, the number of hours you work, and half your time and 750 hours minimum, must be material participation. That's one of the key things, to take away. So it has to be on that list to be qualified towards a real estate professional. So what that means is that, on that list, you as a real estate professional, have to be involved in the activity in a way. And, the 3 words I underlined on this was, regular, continuous, and substantial are the key things to take away from what is a material participation that checks the box for test 1 and test 2. Now, the second bullet point we have here That's really, I'm not going to get into that too much. It's really a deep dive into the weeds about, if you do own multiple properties. But if you one of the things that we're talking about a lot here is talking to a CPA. You're going to one thing is buy an accountant and make sure you're on the same page. And if you do own more than one rental property, there's a conversation you're going to want to have with a CPA, deciding to treat all the properties, kind of group them together and treat them as one activity, or keeping them individual. That's sort of a decision that you're going to have with them, but a conversation you should have if you do own more than one rental property.
And it sounds like just, really having a CPA who you can just have conversations with and really just, speak to is going to be pretty important for all of this stuff. At least for me personally, it has been. I don't know about you, Joe and Adam.
I would go even a step further. It's almost imperative, because one thing that I have found that's interesting is, a lot of, not all CPAs are created equal, for a way to say it nicely. Some just, real estate's not their forte. That's not one area they're really well versed in. And Joe and I have actually had calls from CPAs asking us about depreciation. So if you are a real estate professional, for certain, you want to be in the loop with a CPA that's very well versed in real estate as a whole.
Okay. Great. So the next topic is really about, all right, so how do I prove that I'm really a rep? And there's some really, specific things that you have to do as a rep in terms of logging and tracking those hours. We do have a pop quiz question on this one. Let's go ahead and get that one going. All right. All right, we just pulled up the question. Just want to see if the audience here has a general understanding of what this might be. So what is not a criteria for logging rep hours? Okay. Few more seconds. This was actually a really tricky question. I gotta admit, we were a little devious on this one. They all sound good. They all sound good to me personally, and I know the answer, but I know we all know the answer. But all right, so several of you picked. Let's go ahead and we'll go ahead and end the poll. We'll give you guys a few more seconds. I see a few people are still in there. Okay, so the correct answer is, so everyone got this wrong. It is not the time spent performing the activity that's actually required. A detailed description of what was performed is actually also required. The wrong answer here is travel time to and from a property. So that is, and as you can see, this is how tricky this stuff is, and that's why it's really important to kind of spend some time talking through it. So let's go ahead and get into it. So I'm going to just say a few things here, and before I hand it over. So I think, now that you guys understand what real property trades and businesses are and what material participation means, again, I think this is probably the next most important thing to make sure that you understand well and that you do it really well. This does require some preparation and being organized at the beginning of the year or whenever you think you become an active rep. And it can be a headache for some people. As I've been digging into this over the last couple of years, I've had people come to me and we've had really, in-depth conversations. If you go online, you'll see a lot of people going back and forth about, what it takes to track and log this stuff. But if you create a daily or a weekly process, the people who I know do it well. They just have a process where they just sit down, they bang this stuff out in their little log sheet, and they're ready to go. This has become muscle memory for them. They do it really well, and it's really no issue. And you may never need it. So, but in case the IRS comes asking for it, come filing time, or after you filed and they want more information, or that you have an audit, you will need to provide this something that's legitimate and meaningful. So it's better to be prepared. So Joe, let's go ahead and dive into this.
Yeah, Sean, just you already made some key points here, and I'll just piggyback on what you said. But logging your hours is absolutely critical. This is really your only way of substantiating, the out, not only the number of hours that you worked, but also the material participation requirement, what activities, are allowed. And you basically need to be able to provide a detailed record, things like what properties you serviced, what was the actual work done, and how many hours, etc. And the times that they were performed, how long they took, because you need to add all this up. And you also have to remember that it has to make sense too, right? Like some people don't keep very clear records, and they go back and then they try to fake something, 6 months from six months ago, and they don't recall exactly what they did. Well, what happens is sometimes you could actually put in stuff that doesn't make any sense, like, maybe working 18 hours, on one day, on a Saturday, or Sunday, whatever. Or maybe I don't really have any specific examples right now, but you just got to make sure that the activities actually make sense, otherwise, even if you kept good records, they will trigger red flags. And remember, when you claim a rep status and you're not a true rep, there's a very high likelihood of getting audited. And if I could just, maybe tell you a little, I'm just going to segue into a little story here, but they actually introduced this rep status requirement sometime in the mid 1980s. And the reason why the IRS had to do that was because there were a lot of very well-to-do professionals, such as doctors and lawyers, buying properties and using the depreciation benefits to offset their active income, the wages that they earn, practicing medicine or law. And the IRS took notice and said, well, no, you're not really a real estate professional. You're a physician, you're a lawyer. And therefore, you can't really use these benefits. And that's why they came up with those three different criterias, the material participation, the minimum number of hours that you need to work, and then that it needs to be your main work function. So here's an example I like to give to our investors. If you're a super duper human and you're doing 60 hours a week, practicing medicine, and you're also doing 50 hours a week, doing real estate rentals. Well, on an hourly or on a minimum hour basis, you'll probably qualify for the 750 hours. But because you still spend the majority of your time practicing medicine and not real estate investing or real estate managing real estate, therefore you do not qualify as a rep. And so I want to kind of mention that, and that's where this all came about.
Got it. And then I think that's a really good kind of explanation of this. And I think the other thing I also want to kind of stress is I think people shouldn't be scared about, oh my God, like if you're a rep and you think you are a rep, dig into this a little bit more. Just make sure that you're meeting the tests, that you're materially participating. And if you are, you have nothing to worry about. Like, there's hundreds of people, there's thousands of people out there who are claiming rep status. And when I said hundreds, it's just people in our group that we know of, that are doing this. We're doing it, and we're not worried about it because we're just prepared. So I think the key here is preparation, and just, and just doing this the right way, and, not trying to cut any corners, and you'll be fine, and if someone does knock on the door, you have everything you need, there's really nothing to really worry about. So, all right, let's go ahead and talk a little bit about applying this strategy like we usually do, like we did in the last, in part one, we talked about applying the strategy for non-reps. Let's talk about applying the strategy for reps. And I think this one, I'm going to hand this one over to you, Adam, and let's talk through it a little bit. The key objectives.
Yes. So, as we discussed, so now let's say you've qualified as a real estate professional. Now, the next goal now is to offset as much of that taxable income as possible through depreciation. So what were the next steps? So the first step really is, have an idea of how much income you're going to have. I mean, you should know this, but again, still, if you have any questions, talk to your CPA to try to get down an actual number on it if you don't have it. Now, the second one is so once you have the idea of how much taxable income you're going to have, you're going to look to offset this with real estate investing that provides depreciation, bonus depreciation. So we highlight a couple ideas of ways to go about that. Is, first of all, if you are a real estate investor and you have a rental property already, a good idea is to do a cost segregation analysis on that property for the tax benefits. Now, I always like to give I know real world examples of this is at any point you can do this if you haven't, taken the bonus appreciation yet. Now, I'll use my parents as an example. They have sort of it used to call it the guest house, and they decided several years ago they wanted to rent it out. Now, they had owned it for quite some time, but since they were just starting to use it as rental income, they did a cost segregation analysis and got the bonus appreciation to offset any passive income gains. So you can do this at any time you have a rental property. So if you have a one and you've not done this yet, that's a great way to get depreciation to offset your W-2 1099 earnings. Now, the second one, and this one is the easier way to do it, is to invest in a real estate syndication that offers depreciation. Vast majority do. I know all of ours do. So this is the second way to do it. I know we've touched upon what the bonus appreciation levels are, but the deal that we closed at last December, Break Day Capital, it gave investors about 70% bonus appreciation on their investment. So if you invest $100,000, you got $70,000 of bonus appreciation you could use to offset taxable income as a rep. And although the number still went down this year to 60%, it's still significant that if you invest in syndication, there should be a huge amount of bonus appreciation to offset your taxable income. And lastly, I know we've reiterated this several times this evening, but do speak to your CPA. Make sure that your CPA is well-versed in real estate, and make sure he does file you as a real estate professional that allows you to use depreciation to offset your taxable income.
All right. So we've talked a little bit about the strategy here. Let's go ahead and talk about a little bit about how we can apply this and give some real examples, similar to what we did in part one. So Joe, you want to go ahead and walk us through this example? And also, Joe, if you don't mind, I know we have it after this. Maybe we can also talk about how someone uses this, over the course of 12, 13 years, like over a decade, and benefits from this scenario, and how that compares to the stock market. Because, a lot of us we're diversified, right? We don't put all of our eggs in one basket, but we like to take advantage of real estate because of all these amazing benefits. And, how do these two compare, and what does that look like?
Oh, definitely. So this graph here, this diagram here, basically illustrates exactly what Adam just mentioned. Okay, so when you look at the top there, we're assuming, and these numbers are they're very dynamic, but this is just an example. Let's say you earn $90,000 in income. And for the sake of this webinar, it could be that income could be from your wages, it could be from your K1, it could be from a 1099, if you're a consultant. So here we're not going to distinguish what type of income, whether it's active or passive, because as a real estate professional, it's just all one bucket. So all your depreciation can be used to offset all of your income, right? That's what makes having rep status so powerful. But for the sake of this illustration, you earn $90,000 in income, okay? And at the same time, you invested in one of our deals. Let's say you invested $150,000 in our impact fund. We give you, for this year, we're able to give you 60% depreciation. That's the maximum amount that's allowed for this year, okay? So $150,000 investment, 60% bonus depreciation gives you a $90,000. It gives you $90,000 worth of depreciation or passive loss in this taxable year. And that basically would defeat the $90,000 that you earn, from the variety of income that you may have. And what that means is you, instead of paying $27,000 in taxes and only netting $63,000 at the end of the year, you would have no tax bill and you get to keep all 90. Okay. That's how powerful depreciation is. And then Sean, if we could go over to the next couple slides and we can talk about what is this. So that was just for 1 year, right? What happens if you kind of play this out over a decade? And so we have 2 examples to show you here. First one is, this is a very typical, stock portfolio for a lot of people, right? And so here you could see that if you were to invest $100,000 in the stock market, let's say the S&P 500 index fund, and you just sort of, over the next, over a decade, this is what you would end up with. You're just compounding at 8%. And then over a course of 10 years, or I'm sorry, 13 years. Oh, why do we pick 13? Anyway, you could see how your $100,000 turns into $241,000, which is roughly a 2.4x return. Now, instead of putting all your money in the stock market, this is what would happen if you were to invest in real estate syndications instead. So if we can go to the next slide, you can see how powerful it is. So you can see that same $100,000 that if you had invested in real estate syndications instead, you would actually net $610,000 at the end of this 13-year period. Okay, so this is a 3x increase. This is a 300% better than just having your money in the stock market. Okay, and the reason why this is possible is because not only are you compounding at a higher return, we're targeting sort of that 15 to 20% IRR versus the stock market of 8%. So not only are you compounding at a higher percentage of return, but you also get to use the depreciation benefit so that you get to keep more in your pocket the whole entire way. And so you're basically saving more, but you're also growing more. So the net benefit is that you're going to do much better versus just being in the stock market alone.
Awesome. Yeah, this is a really powerful, these last 2 slides, we review them with investors all the time. And I think this is really what the aha moment that happens after people understand the comparison between the 2 investments. And it's not like we're saying, you're diversifying. You have money in the stock market, but you take a little out, invest it in real estate syndications or something that's providing you, this bonus depreciation. And then, as you can see, the numbers kind of speak for themselves. And of course, there are assumptions in both. We're assuming that the stock market will give you 8%. That's been the average, historical average over the last, 50, 100 years, whatever. It goes all the way back. On average, syndications, in real estate backed by hard assets are giving people anywhere from 15 to 22%, as you mentioned. So that's pretty standard. And, so that's kind of, that's really what the models look like. And then I think we'll wrap it up here, and then we'll go ahead and I'll hand it over to Adam. So I think if you really want to qualify for rep status, then cost segregation, bonus depreciation to offset your active and passive gains. That's the key takeaway. Figure out how to do it. Talk to your CPA. Identify a real estate investment that allows you to diversify your portfolio so that you can actually, take advantage of these tax benefits. Because if you really don't have that piece, that's the missing piece. And you don't really have anything to offset you know, the income, the passive, the active income that we're talking about. And then, you know, I think use the depreciation to fully offset your taxable income. If you have extra money and you can actually deploy it in assets that are depreciable, you can actually do the math and figure out exactly how much you need to invest so you can fully offset, you know, and just have no taxes to pay. And that's what a lot of us, that's what a lot of the real estate, the savvy investors that you hear talk about, you know, growing wealth and, you know, and generational wealth. This is how they're doing it. These are the tactics they're using. So with that, Adam, you have a couple more to talk about, then we'll go ahead and we'll back to you to kind of wrap it up.
Yeah, so sort of to conclude here, we talked to when I said in the beginning, at the very end, we're going to talk about ways that you can benefit through real estate and avoid taxes. The currently at Break of Day Capital, we have two offerings, quite different. I'm going to go over the Break of Day Capital Preferred Income Fund, the one on the left side of the screen. This is an ideal investment for people who are looking really to preserve wealth. If you invest in this fund, you get an 8% return, an 8.3% return if you opt to reinvest the dividend. So that return is significantly higher than what people are getting right now in a money market account, a CD, a fixed annuity. And the 8% is locked in. That's the return you're going to get on this investment. While your bank account investments, your CD, if the Fed cuts rates, which most likely they're going to, that rate's going to go down significantly and quickly. So you get that 8% return, and it's locked in with monthly distributions. And what I love most about this fund are the 2 points on the bottom. Is one, liquidity. You get an 8% return, which is pretty close to the stock market historically, but we've seen what's happened to the stock market the last few days. A lot of volatility. So you get this 8% return, and once your money's been in the fund for 90 days, the first week of every month, you can request your money back. And if you do, your money's returned to you within 45 days. Most funds don't work that way. Most funds give you a very narrow window every year to ask for your money to be returned to you. And if you do request it, it could take months to get your money back. So there's this great flexibility. And what's also great about this fund too is because this is a real estate fund, that 8% return you get, or 8.3 if you reinvest the dividend, you can use depreciation to offset paying taxes on it. So you get that rare benefit you don't often see with income funds. Now, the multifamily impact fund on the right side, this is an ideal investment for people with a longer term horizon. For this fund, we're the equity multiple we're targeting for this fund for the deals in it are anywhere from 1.7 to about 2.2 times. So every deal in this fund, our goal is to double our investors' money within a 3 to 5 year window. In this fund, your money's going to be diversified over several properties. There's one property currently in it, but it's going to be diversified over several. And it's based on the capital raise. So let's just keep the math simple. Let's say we make 3 equal acquisitions of $10 million with capital raise of $10 million each. Your money would be to put a third into each deal. Now, when each deal goes full cycle and we exit it, you get your principal back and then the big upside. And what's great about this is, we spent this evening talking about depreciation, bonus depreciation. You invest in this fund, you do get that big tax benefit. There is bonus appreciation for your investments. As on the top of there, we talk about there's 3 different classes of investors. Not going to get into that tonight. We can get into that on an individual call with you. So we are going to open this up to questions. So as we talked to you before, please, any question, put in the Q&A box at the bottom of your screen. So next steps. The first one, booking a discovery call with us. You can do this on our investor portal. If you can scan the QR code or go to our webpage, breakofdaycapital.com, where you can schedule a call with me. You can also see on the screen here under my photo, my email, adam@breakofdaycapital.com. You can email me if you would like to set up a call, or you can call or text me at that number as well. That's 602-529-2056. We're here to answer your questions. We want people to be comfortable investing in real estate. So please, any question you have tonight, ask it. And I highly encourage you to follow us on social media. You can connect with Sean, myself, or Joe on LinkedIn, as well as Gary Lipsky himself. And also follow us at LinkedIn, at Instagram or Facebook as well.
Awesome. Thanks, Adam. So yeah, this is completely open to the audience. Please go ahead and ask. All right, so we do have questions coming in. So the first one is, hi, can I please get a replay of this as I just managed to get on? Sure. So Neil, we will be sending out the recording. So, if any of you joined late, or, for the people who actually missed it, we will be sending out this recording. So don't worry about that. You'll get the full recording. Next question, how will bonus depreciation be applied to the multifamily impact fund? That's Joe, you want to take that one?
Sure. So Adam mentioned this a little earlier, but when you invest in the impact fund, and I'm just going to talk about specifically for this year, we are expecting to give you up to 60% of your investment dollars in depreciation. Okay, so once again, that passive loss, that bonus depreciation, can be used to offset a variety of incomes, depending whether you're a rep status or not. And I should maybe take a moment to just reiterate that in the previous webinar, it was more focused on passive investors, people who are not real estate professionals, and there are still many ways that you can use the bonus depreciation against a variety of other passive incomes. Okay, so feel free to book a call with us, or if you want to refer to the recording, you'll get a lot of information there. But otherwise, the bonus depreciation that we're going to give you from the impact fund can be used to offset, again, a variety of incomes. And as of right now, we're expecting to be able to give you up to 60%.
Yep. All right. Good question. Next question we have is, are the investments only for new cash or also 1031? Either of you want?
Yeah.
Want me to do it? Are you going to take it, Adam?
Sure. Yeah. We get asked this question quite a bit about 1031 exchanges. Can you 1031 into one of our deals? And yes, you can 1031 into one of our deals, but it's complicated. Because if you 1031 into a deal, your name has to be on loans. There's a lot of just additional paperwork to 1031 into one of our deals. And remember too, with the 1031, there's a timeline. You have 45 days to choose a property, and then you have 180 days for the property to close. But the good news is, for those who are looking at 1031, there's another option, which is a lot less complicated and simpler, and it's called a lazy 1031. And if you decide to, the way to lazy 1031 into a deal is you take the proceeds, and again, there's, unlike where there's a huge dollar requirement to do a 1031, a lazy 1031, we will take, whatever minimum is at the time, that's the minimum you can invest that or more into one of our deals. And if you do the lazy 1031, what happens is rather than pay the capital gains tax, you get the bonus appreciation. And the bonus appreciation, you apply that towards your capital gains to offset them. And what's great about the lazy 1031 is, one, the stopwatch. as you said, the 1031, you have 45 days. In a lazy 1031, you have the calendar year. So if right now you've just sold a property and you're looking for to put your money into another deal, you have until December 31st. You have quite some time. So it's a lot simpler, a lot easier way to do it. And all of our deals, you can do a lazy 1031 into them.
So JB has a follow-up question on this one. So no traditional 1031 option with your firm. I have no interest in a lazy. So again, I think what Adam's saying is we actually do both. Like we can do the traditional 1031. The trick is just the timing. You have to sell your property around the same time where we're offering. We have a single property syndication, a deal that's offering the bonus depreciation. And if that timing coincides where you have 45 days to identify potential investments that you want to reinvest in, you would identify the BODC syndication, the deal that we have, and we would work with you to file the paperwork, and it's just a lot of paperwork, and it's something we do. So no issues doing it. It's just that your timing would need to coincide, with our timing, and that's really the biggest kind of requirement. Good questions. Any other questions? We're doing really great on time. We plan to wrap this up around 5, or we have time after that. So please keep your questions coming. All right, next question. Have you heard anything about 100% bonus depreciation being reinstated?
Yeah, I can take this one, Sean. Yeah, this is something there've been rumors floating around since the beginning of this year that Congress is interested in reinstating the bonus depreciation amount back up to 100%. And the proposal is to basically make it retroactive to 2023. In 2023, we got to take up to 80%. So they would make that retroactive back to 100%. And then for the remainder of the 2024, 2025, 2026, they would also want to bring that back up to 100%. That was the original schedule from 2017 to 2026. That was the period for the bonus depreciation. As of right now, I don't think that bill has been passed. They're still working on it, but obviously, we don't know for sure what will happen. But I think we will probably know, after whoever gets in the office this year.
Yep, got it. Well, it looks like people are really interested in this, the bonus, the 1031. So with the 1031 potential, is this a non-recourse loan?
Yeah, this is a good question. Generally speaking, it's a non-recourse loan. But every situation is different. We have certainly taken on loans in the past, that have partial recourse, but in general, we would prefer to have non-recourse loans. And then as far as the debt to equity percentage, that really depends on the deal. We're somewhat capped by, we have to meet all those conditions, right? The DSCR, loan to value, loan to cost, and it's really, up to not only in terms of our own risk management, but also, the lenders will cap you at whatever they're comfortable with. So really, they're in the driver's seat. But I understand that when you're doing a 1031 exchange, if you already have debt out of the property that you're selling out of, you need to exchange both the equity and the debt. So basically, you need to invest your entire proceeds. And generally speaking, that the LTV, the loan to cost percentage should probably line up.
Got it. All right. Any other questions? And again, feel free, you might think of other questions. This is really dry and deep stuff. So again, feel free to reach out to, Adam, Joe, myself, you know where to contact us. You'll be getting emails from us with the recap of this and, with the recording. Feel free to just reach out to us anytime, and the entire team is here to answer your questions. And I think, Adam, you were offering a half-an-hour strategy session with anybody who wants one, right? Just to talk about how their situation actually, how you can help walk them through their situation and actually using depreciation in their own kind of personal kind of situation. So I think take advantage of that. Adam is definitely offering that time for anybody who needs it. All right, should we go ahead and wrap it up, team?
Yeah, sounds good. Just appreciate everybody for joining us this evening.
Yeah, thank you all. We thank the audience, and we look forward to having you join us again for our next webinar. Take care, everyone.
Take care.